Investing doesn't have to be complicated. In reality, it may be both pretty easy and financially rewarding. You may be able to achieve results that are on par with those people using complex methods if you do it the right way. There are many different approaches you can take when it comes to investing. A 3-fund portfolio approach is one of them and can be an easy way to generate wealth over time. You can make a decision by knowing how it operates and the advantages and disadvantages of investing in only 3 funds. They say it's a lazy way to invest, but the question is it right for you? Keep watching to find out. So, let's start by defining a 3-fund portfolio. A 3-fund portfolio consists of equities and bonds represented by 3 index funds, often a U.S. stock index fund, an international stock index fund, and a U.S. bond index fund. To keep your costs down when utilizing this strategy, look for index funds with low expense ratios. The annual fee of fund charges, expressed as a proportion of the assets managed, is referred to as an expense ratio. A 3-fund portfolio is straightforward because you won't be selecting particular stocks. Unlike other investment strategies, you are guaranteed to get the average market return by avoiding individual stocks, which is something most expert money managers are unable to do frequently. Remember that if you want, you can also establish a 3-form portfolio through exchange-traded funds or ETFs, as opposed to standard index mutual funds. The 3-fund portfolio's low cost is one of its benefits. The least costly funds to own are the large index funds that are often utilized to build a 3-fund portfolio. Keep in mind that even tiny percentage changes in fees can cause shifts in your future wealth of tens of thousands and maybe even hundreds of thousands of dollars. The ease with which you can rebalance your portfolio assets is the next benefit. Rebalancing is the process of reevaluating your portfolio allocations on a regular basis to ensure you're still on track. The final benefit, and maybe the most fascinating one, is how easy it is to start and sustain this investing technique. Simply said, investors with all levels of experience and skill can easily use the 3-fund portfolio. Now that it appears so simple, you're undoubtedly wondering how effective this approach to investing can actually be. To illustrate how effective this strategy may be, let's review the historical performance of this portfolio mix. Many professionals in the financial industry sincerely believe that if you have enough experience and knowledge, you can outperform the market and earn handsome returns. Moreover, although some money managers do outperform the market in the short term, success is typically limited in scope. Universities, which employ numerous financial professionals to safeguard the performance of their endowment funds, are one set of individuals that preserve this investing mindset. Recent studies, however, revealed that even the most savvy investors are unable to match the returns that a 3-fund portfolio can provide for endowment funds. On time horizons of 3 years, 5 years, and even 10 years, the 3-fund portfolio beat top quartile endowment funds. No considerable level of investing expertise or the requirement to constantly rebalance your portfolio were necessary for this high-level success. These results were produced thanks to the 3-fund portfolio investing strategy. This strategy has several benefits over other investing strategies, which might interest both new and experienced investors. The diversification that the 3-fund portfolio provides is one of its strongest features. Diversification can occasionally cause confusion as you attempt to mitigate the risks in your portfolio. But if you invest in index funds, you won't need to buy individual stocks to position yourself properly. You will be investing in funds ranging from the biggest firms in the United States to the smallest firms in China by utilizing this portfolio mix. Choosing the stock-to-bond ratio you wish to keep in your fund is the first step. If you're choosing a portfolio mix and are risk-averse, going more bond-heavy is usually the best course of action. Bonds typically experience fewer unfavorable financial occurrences, but as a trade-off, they typically have lower returns due to their lower risk. The good news is that there are a number of models you may use to decide what allocation to employ when putting the 3-fund portfolio into practice. The first of which is the 100-year rule. With this strategy, you hold a proportion of bonds equal to your present age and then let stocks make up the remaining portion of your portfolio. This is a relatively conservative technique, but it works for investors who are more cautious. The rule of 110 has been proposed by some notable investors as a slightly more aggressive adjustment due to the current low bond yields and extended lifespans. The rule of 110 is similar to the previous technique, but now you hold a proportion of stocks equal to 110 less your age. If this overall rule doesn't seem to fit your investing requirements, you can follow Warren Buffett's advice and put 90% of your cash in stocks. Choosing how much of your investment will go into U.S. stocks versus international stocks is the next step. The majority of individuals would presume that the success of your investment depends on getting this component of your portfolio right. However, the thing is, for that a few reasons, the split doesn't significantly affect your financial status. Number one, they will react to financial events in a manner consistent with stocks. Number two, due to the increasing interconnections in the world, U.S. stocks are becoming more and more associated with international stocks. In any event, adding that to the three-fund portfolio will undoubtedly provide diversification benefits. Similar to the last step, we can navigate this tricky path by applying a few tested and proven strategies. The first takes a global economics perspective. In this strategy, your stock holdings are divided up in the same ratios that they do in the global economy. Although it could seem difficult to understand at first, it's actually pretty simple. About half of the global economy is made up of U.S. stocks, with the remaining half being made up of international stocks. In this scenario, an investor would divide their three-fund portfolio stock holdings equally or 50-50 between their preferred U.S. stock market index fund and preferred international stock market index fund. The 20-40 method should also be taken into consideration. Vanguard suggests that a decent starting point for international exposure is 20% of your stock portfolio. They also advise clients who desire more international exposure to increase it to 40%. You will be 90% of the way through implementing the three-fund portfolio after you decide how much of your investment portfolio you want to allocate to bonds and how much to divide between U.S. stocks and their international correspondents. However, there are a few more steps you need to do to guarantee your investment success. Establishing specific objectives and goals is the first one. Of course, the three-fund investing strategy is simple. You'll want to make smart choices that are in line with your investment, such as how you'll distribute your assets across various categories and how much risk you're willing to take. Next, in order for these goals to be accomplished as you continue to invest, you must make sure that you review them. To guarantee the consistency of your investing efforts, you should also establish automated investments. Getting your account set up and operating is a smart idea. And keep making monthly contributions so that you can benefit from the returns that this portfolio has a reputation for producing. A three-fund portfolio approach has its benefits and drawbacks. Just like any other investing strategy, you can decide whether or not something works better for you by considering both perspectives. To start growing your money, make sure to use this three-fund portfolio investing strategy. That's a wrap for this episode, which we hope you enjoyed and learned something from. If you liked this video, don't forget to give it a thumbs up and subscribe to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.